Welcome back, folks. I hope that you all are doing well. Now that you have seen the execution, let's do a top-down analysis to see what was behind the trade. Take a second to look at the range shaded in yellow. Pause the video if you wish and note what you think that is important. 3, 2, 1. Okay, it is pretty obvious that there were relative equal lows creating a sell-side liquidity pool. Besides, we were trading in a consolidation inside of a 4-hour sell-side imbalance buy-side inefficiency. So, I decided to frame the range from the low to the high to get the equilibrium point and its PD arrays. These levels are from the optimal trade entry model that ICT teaches. But I will focus on the midpoint and that discount 4-hour fair value gap. Note the reaction that price offered at the midpoint of the FVG. This shows the importance of framing ranges. You should start using them in order to get a greater view of the market, since you can get the key levels in price that can be used as entries or targets. Well, take into account that we were trading inside of a range. This tends to create seek and destroy conditions. That is why once it swept the buy-side liquidity it left relative equal highs. Once we see this signature in price, our eyes should go straight to the sell-side liquidity pool, since it will be possibly rated. This red shaded area is where smart money sold. The model was valid due to the displacement inside of the range that occurred once the buy side was swept. If price would have not displaced lower, we would have not considered taking the trade. Rules are very important in order to be profitable. I've learned that the hard way, so it's better to follow them. This is what the 5-minute chart looks like. Look at the market structure shift that occurred once the buy side was swept, leaving a 5-minute fair value gap in the displacement leg. This is our 2022 model. So, where we could be taking profits. We could aim for the sell-side liquidity pool below the relative equal lows or the 4-hour fair value gap that we framed a few slides ago. As you can see, the move was extremely fast and massive. These are the kind of trades that we should be taking. We have finally made it to the 1-minute chart. I was looking for a move lower, as you already know. I could have entered on the first FVG after the market structure shift, but I was waiting for the silver bullet time window. Once I saw the 5-minute fair value gap I knew that we were going lower, so I decided to enter after that turtle soup. It confirmed that we were going to start moving fast to the downside. That is why you saw me frame an inversion fair value gap before it formed in the execution. My target was those relative equal lows below the equilibrium point, even though that I could have aimed for the sell-side liquidity. But why I knew that the sell-side liquidity was going to be purged? Well, if you take a look at the move higher to the buy-side liquidity pool, it was a steady move, without many lows or highs. This kind of moves are low-resistance liquidity runs when they get attacked, since price will melt through them as if it was a hot knife through butter. That is why you should be trading against low-resistance liquidity run moves in order to avoid choppiness and retracements in your trades. Well, you have made it to the end of the video. I congratulate you for watching it, and I hope that you have learned something new. Leave a comment and a like if you enjoyed it. Don't forget to subscribe. Be safe and good trading.